Hey there, it's Mitch Goldberg. How are you? Thank you so much for joining me today. I know your time is extremely valuable, so it means a lot to me that you chose. My name is Mitch Goldberg. You're watching my live stream. It's called Be the Boss of Your Money. It's about personal finance. It's about control. It's about you taking control of your personal finance, of your money, because somehow life has a way of turning the tables on you, and all of a sudden your money is in control of you, and you just can't get off that spinning hamster wheel. So let's talk about that. We've got a few things to talk about today. Why did the NASDAQ just get absolutely mauled today, down over 400 points? On the NASDAQ, usually when you talk about 400 points, it's usually about the Dow, but now we're talking 400 points with the NASDAQ. It's a pretty significant decline. It's spread to every other sector of the market. Things just got generally pulled down. We went from hitting new highs yesterday in the Dow and the S&P to feeling like the party's over just a day later. What's with that? A few other things I want to explain to you, some of the terms that are used on Reddit, because they're kind of seeping their way into our cultural lexicon. So I'll make sure you understand those, and I've got a couple of slides that I'm going to share with you. This is going to be a really good show, and you're going to learn a lot. So I'll roll the intro. Here we go. Hey there, thank you so much for joining me. My name is Mitch Goldberg, and if you're watching this in the live stream, if you have any questions, hit me up in the comments. Go ahead, do it right now. I want to collect your comments. I want to collect your questions, that is, and I want to, collect them and then answer them, because that's the best part of this live stream. I love answering your questions. I love hearing from you. Words of wisdom, words of encouragement are always appreciated. If you're watching in the replay, welcome to you as well. And I would love to hear your questions, or I would love to see your questions in the comments as well. And you're watching this now, you might as well give it one of these, a thumbs up, maybe a heart, because when you do that, I get to see who's watching. And if you don't want to, privacy is a concern. I get that. I don't have to know. But it's always fun. Let me know where you're watching from. And let's make sure that we've got just a rocking little show today. So we're going to get into it. First, let's talk about the obvious thing. NASDAQ was down a lot. It was down over 3%. That's a pretty steep drop. 0.5% or less doesn't really get my attention. It's not a big deal to me, and it shouldn't be to you either. I mean, the fact is, if you're a long-term investor and your goals are far into the future, I think none of this stuff really matters except for one very important thing. I always ask, what good is an investment portfolio, investments account, if you can't stick with it? And this is to help you reinforce your why, your goals. And then you have your investments. And sometimes you might think, I better sell everything because I don't like the way the market's looking. I don't want to lose money. What happens is you sell. What very often happens is you sell, you lose money. You lock the losses in, the market goes back up, and you then get back in. And you're trying to time it. And, listen, some people can time the market. Some people can time with part of their portfolio. Some people shouldn't. And most of us are just better off investing for the long term. I'm not saying buy and hold forever, but buy and evaluate, reevaluate, rebalance. So what this is about is making sure, one of the many things this is about is making sure that you have a portfolio of investments that is right for you, that you'll stick with, that you're not going to bail out of. I could give you the greatest, highest return portfolio ever, at least in our own opinion, right? But if it goes down a lot and you sell it because you were worried about it, then what good is it? So the idea is to invest according to your risk tolerance. Folks, if you're out there, I know you're out there, but listen, if you have any questions, hit me up. with your questions in the comments. It's really the best part of what I do. I want to share something very important with you, okay? So first thing is this. Why did the NASDAQ get hit so hard today? It's because interest rates went up a lot today, up 11 basis points. That is, that would be a significant move in any market environment. But when yields are still so low, the 10-year Treasury under 2%, that yield went up 11 basis points in a day. That's a lot. That is a pretty big move. So we were thinking here on Be the Boss of Your Money that, 1.6% was the line that separates optimism from pessimism with the high-tech growth stocks that everybody loves. Maybe the yield is more like 1.75, and above that, stocks can't tolerate it. My thinking was we could be 2.5% by the end of the year. Could be. A lot of people disagree, and some people think we'll be up not as much as that. We'll see. I mean, it's kind of early, I think, to start. Everyone wants a year-end forecast. I'm willing to do it, but I'm also allowed to change my mind, okay? But I'm still sticking with that 2.5%. So let's just take a look at what I really want to show you. This is something that you're going to see a lot of. I'm going to put this on the screen right now, and I'm going to put it on more than once, okay? You see that? Why does rising rates hurt high-priced growth stocks? Because rising rates, let me stop the banner for a second. Okay, because rising rates makes their future earnings less valuable today. Since growth stocks trade on expected future earnings, this depresses their current valuations. Rising rates go up, okay? It makes the future earnings of a growth company less valuable today in today's dollars. And since growth stocks are priced based on expectations of decent earnings in the future, they come off a lot. It depresses their current valuations. And that's what you're seeing right now, okay? I'm going to now come back to the screen, okay? So I want you to know that. So let's take a quick look at how things did. I'll pop myself up here in the corner. Hello, here I am up in the left corner. Couple of things. Okay, so you see this, the Dow. Let me make the screen a little bigger so you could see it. Let's get rid of that. Let's put markets in. Major averages. Bada boom. Let's scroll down a little bit. Okay, some top performers, some bottom performers. It's not really what I care, but here it is. The 10-year Treasury at 1.71%. So it's definitely getting up there. Okay, it's definitely getting up there. When I say there, I mean it's getting up there. All right, so let me get rid of that. Let's get to US. This is what I'm really looking for, stock indexes. Okay, so you see this, the Dow was off 153 points. That in and of itself is no big deal, except for the fact that the Dow was a lot higher today, and it was actually touching intraday record territory. The killer, though, was the NASDAQ down over 3%. That's pretty significant in a day, and it doesn't feel like it's a blow-off drop, like, oh, we'll just have a big swoosh down, get the sellers out of the way, and then the buyers could come back in and take us to new highs. That felt like the last couple of days, but the fact that the NASDAQ couldn't recover to its all-time high and backed off, I don't know. I think it's a little bit of a negative to me is actually what I think. Gold worked. Oil tanked. Oil down 8%. Now, I want to say something about oil, okay? I'm going to just go back to the main screen here, okay? I want to go to screen number 2, okay? I want to say about oil. Oil is a function of supply and demand. When the demand went down because of the pandemic, the deep recession, the economic shutdowns, what happened, not only did demand go down, but suppliers cut back on production. In fact, a lot of suppliers, oil suppliers, drillers, they went out of business. So wells were shut down. Fracking was in a lot of places was either reduced or halted. And then we're getting a swish of demand coming back. I'm into that word today, swish. And what's happening is there wasn't enough supply to meet the demand. Like nobody's going to start drilling immediately just because you have a couple of good weeks of demand. And people have, drillers spend a lot of money to drill. If they're not convinced that the demand isn't going to stick around, they're not going to increase supply. But they are increasing supply. One of the reasons oil went down is because of an expected rise in inventory. We don't have a lack of fuel. So I see a lot of people saying, oh, it's politics that oil went up the last few weeks. No, it's because the economy started reopening the last few weeks. Demand is up. More people are flying. People are driving. That's why oil went up. But as you can see, it backed off. There is no shortage of oil. Okay, so just wanted to get that in there. Okay, so let's get back to the share screen. All right, so we have transportation's off a little bit. NASDAQ 100 off a little bit more than the overall NASDAQ. Most commodities were down today. Natural gas, gasoline, silver was up a touch. Copper was off, wheat, soybean, and treasuries yields were up. Short-term yields were still down. We're actually down 0.015 in the 3-month T-bill. The 10-year a little over 1.7, and the 2-year, I believe it touched 2.5% today. So I'm going to have to start incorporating mortgage rates into this show one of these days. And let's see if we could pull up how crypto did. Crypto's an important thing these days, and whether if you think it's worth something or not, it is a $1 trillion market just in Bitcoin. It could be the biggest tulip mania known to mankind, but it is worth taking a look at. Off a little bit down to 57,000. It was over 60,000 over the weekend. Like a week and a half ago, people were like going crazy. It hit 50,000. So the fact that it's at 57, it's really, Bitcoin is pretty quiet today. It's been pretty tame, especially for something that is typically very volatile. Something else I want to show you here that I think is significant. This just goes to show you the encroachment of new media into old media. NFL finalizes new 11-year media rights deal. Amazon gets exclusive Thursday night package. Now, I realize Thursday night is kind of the B team. It's kind of like, yeah, that's the second-rate football games. Of course, it depends who's playing, but still, where is Fox and ABC and CBS Sports? Like, Amazon is now getting a piece of the football world, and I think you're going to see that happen more and more. And maybe Netflix will do something with sports. It just to me strikes me as like another move of new media into old media. So I thought that was worth pointing out. A few other things I want to show you. Now I want to show you something here. I want to talk to you about Reddit and GameStop, okay? I've got a couple of people out there. First, I just want to say hello to Josh. If you set me up with the greatest portfolio ever, I promise I won't sell till it's time to retire. At this rate, I'll be 90. Well, you know what? Maybe even 90 could be optimistic. I'm just kidding. That's good for you, buddy. I hear you. Well, we're living longer, so we get to work longer. The idea is that we have to take care of ourselves physically, like actually take care of our health. Okay, so I want to put myself up here in the corner. Wait a minute. I'm showing you the screen. Okay, I see what's going on here. I have the screen here covered for a reason. I want to make sure I'm doing this right. Okay, so I want to show you this. I'm going to put this up here, and I don't think I could do a screen share unless I do it like this. Okay, I'll put that there now. Maybe I could do that. Okay, it doesn't matter. I'm not in the screen, but I want to show you this picture. Okay, now you've probably seen this. Now, let me start again. You've probably seen this picture a million times for funny memes. You see the guy in the middle walking with his girlfriend, and I guess he sees the younger one walk by, and he looks, and you see the annoyed look on his girlfriend's face. This has been an ongoing meme for a couple of years now, and there's actually like a whole like a bunch, like a whole like 10 memes that go together. Like the guy in the middle and the girl on the right in the blue tank top got married, they had a baby, and the guy was like such a jerk. There's a whole riff on this thing. But anyway, investing according to Reddit. I thought I actually made this myself. It was so appropriate. The rocket is there because that's like very common when people talk about the Reddit meme stocks like GameStop, for example, AMC, and other stocks that got caught up in the short squeezes from about 5 weeks ago. So let's talk about the definitions. Okay. So we have paper hands in the middle. Paper hands means, let's get rid of that. Paper hands means that a holder of a stock or crypto who will sell at the first sign of danger. They're up a little, they're down a little, bad news, good news, they just sell. They're paper hands, okay? They're ephemeral. They are ruining the market and annoying to the diamond hands. The diamond hands make fun of paper hands because the paper hands, they create volatility for nothing. They make a stock go down for nothing just because of fear and bad investor psychology, overreacting. Diamond hands are holders of a stock, are very strong hands. And for the most part, they hold forever. Even if a stock or crypto goes up a lot and it could go down, they hold forever, no matter what. So it's the complete opposite of paper hands and diamond hands. And tendies, okay, tendies are profits. So when you hear young people talk about, got to get my tendies, got to make some tendies, making tendies, hashtag tendies, okay? I'm doing all these things. You can't even see me on the screen. Let me do that again. So you hear people talk about hashtag tendies, making tendies, got to get the tendies, hashtag. That's what they're talking about. They're talking about the gains, Gainz, the gains. Okay, that's what they're talking about. So, paper hands are short-term holders. Diamond hands are forever holders because a diamond is forever. And tendies are the gain. So this is appropriate because you see the paper hands with the diamond hands, but the paper hands they'll jump on to anything else that looks better at the moment because they're always chasing the short-term tendies. I got the little diamond on this girl's hand down here. So I just wanted to explain to you what all of these things, these terms mean. Okay. So let's talk about about interest rates. Let's talk about bonds for a second. There's something called duration, and duration simply means for fixed income for bond investors. It means how sensitive a bond or bond portfolio, like an exchange traded fund or mutual fund, is to changes in interest rates. And one of the reasons investors may prefer short-term bonds or short-term bond funds, ETFs, etc., is because they go down less when interest rates rise. Like 20-year corporate bonds are taking a hit right now. Investment grade bonds are taking a hit. But short-term yields are holding up really, they're holding up. Short-term bond ETFs are holding up a lot better because they don't have as much duration risk. So this is why if you're looking for a fixed income component in your portfolio and you're looking for giving you a little behind the scenes view. Okay. So camera over my left shoulder down at the screen. All right. So if you go into short-term bonds or money markets, you don't have the duration risk that bond funds could have. So if you're not going to get that much interest to hold on to a bond fund, but you're risking losing your principal, you might want to consider maybe a money market fund that's more stable, even though it has a lower yield. But the yield isn't going to be that much lower because yields are already so incredibly low. All right. So I want to show you the a big bond ETF. Okay, and you may or may not think this is significant. Okay, but let's take a look. This is the quote for BND. This is the big Vanguard Total Bond Market Index ETF. It's a very popular ETF with investors, and certainly, it's a tool that I use as well. But it's run-of-the-mill bond fund. So let's take a look at this, and it's down over 4%. It's interesting. It's down 4.34% year to date, but it's up 4.34% in the last 12 months. I've never actually seen those two numbers exactly the same. So that's kind of unusual. Okay. So definitely a little unusual. So the point is, if you have that, it's down a little bit, and so great, you're getting, maybe this one pays a 2.4% dividend yield, which is better than a money market that might pay 0.015%, for example. But you lost 4.34% year to date on this bond ETF, which is more than the yield. And unless yields go all the way back down again, what are the odds that this bond fund ever reclaims the money that it lost? I'd say pretty low at this point. That's just my opinion. All right. So this is duration risk. And if you're worried about duration risk and rates rising, if you're worried about rates rising and losing value on your bonds or bond ETFs or bond funds, then you're worried about duration risk. And if you take, like, let's say a high yield bond, okay, we'll take a look at the Ishares high yield corporate bond fund and see how that one's doing. That one, okay, you see that is down negative 1.8%. Well, why would high yield bonds, which cameraman? I'm going to go back to camera 2. Why would high yield bonds be down, but down less than investment grade bonds? I'll tell you why. High yield bonds used to be called junk bonds. Okay, and junk bonds are companies that are not as credit worthy as investment grade bonds, and they're junk bonds. High yield bonds are issued by companies that are not in the greatest shape, so they have to they have a triple B minus rating or lower, and they're more in danger of a company is more in danger of defaulting on its bonds if it's issuing high yield bonds because of its investment bond rating. Okay, because of its bond rating. But right now, our thinking is the economy is improving, which is why interest rates are going up. And if the economy is improving, that means junk bond issuers, the companies that issue the junk bonds, it means that their fortunes are improving along with the economy, or at least their fortunes, their corporate health is expected to improve along with the economy. So high yield bonds typically would hold up better when interest rates are rising, hold up better than investment grade bonds. So just wanted to point that out, that there are different ways to structure a bond portfolio, because I know we talk about stocks here a lot. We don't really talk about bonds enough, but there are different ways to structure a bond portfolio. All right. I think that's it on my list. I have a list over here. So we went over the Reddit glossary, tendies, gains, weak hands are just weak holders of a stock or crypto. Diamond hands are holders of a stock or crypto, and they typically will hold on through thick and thin until the bitter end, even if they have gains that they could give back. And we went over this last one, which I'll put on the screen one more time. Why does rising rates hurt high price growth stocks? Because rising rates makes their future earnings less valuable today. Since growth stocks trade on expected future earnings, this depresses their current valuations. That's an important one. I'm going to share that on social media also. And if there's anything that you want me to talk about in my live stream, you just hit me up in the comments. You let me know, and I'll see you. I'm not going to be here on Monday. I'm going to be out. So quick shout out. It's my wife's birthday. So happy birthday, Judy. I love you. I will be out for a few days next week. We'll see how it goes. I'll definitely be out on Monday, probably Tuesday as well. And hopefully I'll be back by the end of next week. Okay. I'll see you soon. Thanks so much for watching.